And for more on the market action, we're bringing into the stream now Chris Zaccarelli, Independent Advisor Alliance Chief Investment Officer. Chris, thanks so much for joining us this afternoon. Stocks are on track to post their first weekly loss after 3 consecutive weeks of gains. What are your thoughts on what's been driving this latest stretch of volatility here in equity markets?
Well, it's absolutely the Federal Reserve. The stock market's been pretty resilient in the face of that horrible war in Ukraine, and clearly this has been a volatile year. But it's this past week that equity investors have turned their attention back to the Federal Reserve. The idea that they're going to be raising rates by 50 basis points or more potentially in multiple meetings is one factor, but also the idea that they're going to be selling down that enormous balance sheet that they have. They have $9 trillion in securities in their balance sheet, and they just said they're going to have a plan where they're going to reduce that by potentially $95 billion per month, or a pace of about $1 trillion a year. So I think that's really what's got equity investors spooked on the whole as far as for this week.
Investors also spooked because they're trying to evaluate as well how much the Fed activity and this tightening may also trigger a recession. What would you put that probability at, even though the Fed continues to maintain that it's mitigated, at least the heightened risk of a recession is mitigated?
I mean, I think it's hard to put an exact percentage on it, but clearly the chances of recession have gone up meaningfully. We saw the Treasury curve invert, meaning that you had longer-term yields lower than short-term yields. That's reversed, but that's typically a warning sign of an impending recession, at least over, let's say, the next 6 to 18 months. So I think a lot of people are concerned there's going to be a recession. You see some of those really defensive sectors like utilities, consumer staples, as those continue to get more into favor. That's equity investors showing you that they're concerned about a recession. Likewise, if you see those longer duration assets like technology or consumer discretionary having a tough time, which we've seen recently, that's also a sign that potentially interest rates are going to go higher first. And really all of those together are what's the problem. The Fed is raising rates because they're trying to combat inflation. And as interest rates go higher, that's all things being equal been bad for tech. And you're seeing that again today with the NASDAQ down over 1%.
Yeah, and it's been the loser on the week, and it's been the loser on the year. And usually we do see this when rates are higher, tech stocks get pounded. Do you expect this to continue throughout the quarter?
I think, markets typically don't move in a straight line. So I'd be surprised if you saw this dynamic play out for the entire quarter in terms of just yields relentlessly going higher and tech selling off. But in general, I do think tech's going to be challenged for most of this year. And likewise, I think yields are likely to be even higher than they are from here by the end of the year. So over the course of the quarter, I'm sure you'll see ups and downs for both. But ultimately, I think the trend is still in place where higher yields and lower tech prices are likely to be the story for the rest of this year.
We're about to kick off corporate earnings season in earnest next week. We know a slowdown in profit growth is likely, but what do you think is going to be considered good enough on results to help support stocks from here?
Well, I think you see the banks kicking off next week, and that's great to see not only how they've done in the past, but what they're forecasting for the future. Really, bank earnings are a great way to get an idea of how the consumer is doing, how businesses are doing. And ultimately, I think if profits can hold up, the consensus has been bringing the profit estimates back down. But keep in mind, profits are a nominal as opposed to inflation-adjusted measure. It's possible that we see profitability continue to go higher, even if the economy is slowing down. Again, the economy has been on a really fast pace. The pace of that increase in the economy is continuing to slow, but the economy itself is not necessarily predicted at this time to go backwards into a recession this year. So I think if there's earnings growth, even at modest levels, let's say single digits, even that 3 to 5% increase, I think on a company by company basis, that would be considered pretty good news. And I think you'll see the stocks be a lot more resilient as opposed to seeing, even or slightly down earnings, which is where consensus has been headed.
How are you positioning your portfolio going into this earnings season?
So, typically we don't try to move our portfolios around a tremendous amount from quarter to quarter in terms of earnings, but we do try to tilt towards sectors which we think are going to be more resilient. So at this time, we're looking a little bit more towards healthcare as a sector. We think it's got the dual benefit of providing some growth as the economy continues to grow. You've also got the idea that with the COVID reopening now in full force, a lot of those elective surgeries and things that may have been put off during COVID are now more likely to get done. So we think there's an opportunity for growth on the earnings side. On the other hand, if we do go into recession, either early next year or within the next 6 to 12 months, the stock market starts to react accordingly. Healthcare is a pretty defensive sector as well, so that's one that we think is a good risk reward, regardless of what the outcomes are this year.
Chris Zaccarelli, who's the independent advisor over at Alliance CIO. Thank you so much for joining us here today.